over the last few years, the Indian economy was caged. And now with the new government coming in and there's significant optimism, hopefully the tiger is starting to roar and will start, the lean and mean, tiger will start shooting as well. So what I want to essentially do is I have a really eminent set of panelists. My extreme left, I have Garry Singh. Mr. Singh spearheads the Asia operations for Pinkerton and has over two decades of experience in the risk consulting industry. To my extreme right, I have Manish, Chokhani, who's among India's most respected financial voices and is chairman of TPG Growth India. To my left, I have Samiran, who actually sort of shares in terms of the alma mater of, first employer, ICICI. Used to be with ICICI. Samiran is looking after Standard Chartered's research team in South Asia as the head of South Asia macro research for the last 5 years. And last but certainly not the least, to my right, I have Sunil. Sunil Sanghai is the managing director and head of the global banking of HSBC Limited, an affiliate of HSBC Holdings. So without further ado, I'm going to get started on our discussions. So let's have each of our panelists make opening remarks about what they think are some of the structural problems that are afflicting the Indian economy. So let me start with you, Garry, first. Why don't you actually tell us briefly about what you think are the key structural problems?
Starting off from what Deepak said, that yes, he's very jubilant about it, it's possible. And looking at the sheer size of Indian economy and the number of Indian consumers which exist in this country, well, 10% should be a minor number to look at. But at the same time, taking few steps away from the jubilations we have about the absolute numbers we've been getting, there is a lot to be seen in terms of what we need to do for it. Because as per some rough calculations, if you have 1% growth of the funding available, and for example, let's say, if we do not have any additional funds available out of the government changing its scheme, if 1% change of funds available, as per I picked up this data from our public domain, it is going to change around 0.2% GDP. So that means, in case we are looking at a 2% GDP change, looking at the present inflow of funds of FDI to us, we are looking at additional $100 billion coming in. So if you are planning to jump from 6 to 10, so these funds, first of all, need to be available. And everybody who funds, whether it's a foreign fund or an Indian fund, is going to look at the overall environment. They're not only looking at immediate gains, they are looking at longevity, and at all times they will look at minimal risk. So where we lack as of now is, we do not convert this absolute numbers coming into what does per capita impact it has. And that's the reason the jubilation continues and the practicality goes away. I picked up some numbers and looking at it, in 2013, China received 34% of all the investment coming into Asia. India received 8.57%. But Myanmar and Vietnam also received 7 and 8%. So are we a country who wants to be a superpower and compared with Myanmar and Vietnam, who have just started to realize where they exist? So there's a bit of change. And quick numbers again for last 10 years of FDI. We have China getting 2 trillion. Brazil, 461 billion, which is 1/5 of the Indian population size. Mexico, 247 billion, and India, 229 billion. So if you look at these numbers per capita, Mexico got more than $2,000 per capita. China got $1,531, and India got $183 per capita. So is this something we're very happy about? If the sheer size of 1.2 billion population takes us to top 5 or top 10, is that something which is very satisfying? I think the key thing to any business is ease of doing business. If you look at World Bank, they have an organization, they release data about ease of doing business. And in terms of India, we slipped from 140th to 142 this year in a total of 189 countries.
Right.
I'm sure you have all read that, but the most crucial part out of this data is when it's a contract obligation resolvement, India stands 186th in 189 countries. That means if a foreigner or anybody comes and has obviously they come and sign contracts with Indians to give their money and take, we stand 186th, far behind Pakistan, far behind Afghanistan, far behind every other country. So I think the biggest challenge which exists here is what we commit has to be done. The strategic risk in India have been going up, and the operational risk have going down. Strategic risks are the risks which people use to decide whether to invest in one country or not, to invest in one region or company or not. Well, thankfully, we have change of government now. We hope to have a better outplay. Another thing why we maybe are not lacking, why we are lacking in overall growth is, let's realize more than 2/3 of India is still living in rural India. Neither we are able to skill them to make them effective human resources. So they continue to be population. We do not convert them into human resource. Nor we are taking any microfinance activities which can take jobs to the rural India rather than bringing everybody to the city. We've already seen the challenge of urbanization we've been facing. So it adds on additional sort of stress on the infrastructure which as such is lacking. Another thing which is very close to my heart, and I do want to put it up, there is a tendency in India to always get the cost of compliance up. The cost of compliance in some of the industries in India ranges from 25 to 30%. It's big money. Look at an Indian entrepreneur, a small time, who doesn't want to comply, straightaway gets a saving of 25 to 30%. We have to even this out. All layers need to be addressed, rather than we can say one change done. And in India, it's a very common thing that the TH-TS factor is very high. Too happy too soon.
So now let me turn to you, Samiran. Can you sort of, on the one hand, we're actually seeing oil prices, downward, the downward movement, and the fact that they're expected to continue sort of having that downward movement with the sort of shale oil, discoveries in the U.S. and the significant supply that's going to add, and so the OPEC cartel itself sort of being in threat as a result. Can you then build on what Garry is saying in terms of how what this means for India in terms of opportunities and threats? Because on the one hand, while oil imports are significant, even exports based on oil are also quite significant for us. Go ahead, Samiran.
Sure. Before I jump onto the oil, let me just give a macro perspective on what 10% growth is all about. If you think of it, growth is a combination of just two numbers. One is the investment rate of a country, and other is a productivity of that investment, which economists typically measure in terms of incremental capital output ratio, ICOR. In 2011 in StanChart, we put out a research report called India in the Super Cycle, where we forecasted next 20 years average growth rate as 9.4%. It's obvious that economists always get their forecasts wrong. So we all know what happened after 2011. But our report had 12 chapters of 12 things that India needs to solve to get to that 9.4% number. When I look back at that report, I can see that none of those 12 factors have been addressed in the next 4 years. But the point is that that assumption of that 9.4% was based on investment rate being pushed up to about 40% and ICOR being kept around 4%, which is the long-term average. What has happened is that investment rate has come down from 40% to about 32-33%, and ICOR has doubled from 4 to 8, which means productivity has halved in these 3 years. So in my view, we could still get to about 6 to 7% growth if we can bring down ICOR down to 4 or 5, which has been our historical average. So the first approach should be to get productivity of capital up. And for that, we need to do simply nothing but clearing of stalled projects.
Right.
That's where capital has got stuck without any cash flow.
Yep.
What you were referring to regarding oil price, etc., that affects through a slightly different route, which is India's structural problem of high inflation that we have seen over the last 4 years. Think of it this way, that if you have double-digit inflation, you will obviously have wage growth at more than double digits, and you are likely to have lending rates at more than double digits. If you have wage growth at double digits and lending rate at more than 10%, how much productivity growth every year you will have to do to earn a double-digit return? So corporate profitability will come down, corporate investment will come down. So from that perspective, lower oil prices definitely help us, and it helps us in terms of our macro stability of $1 per barrel decrease in oil price is equivalent to $1 billion decrease in current account deficit. So to that extent it helps, and it helps a little bit on the fiscal side as well. But we have to keep in mind that according to us, 80 oil price is not sustainable. 9500 is where oil price probably is likely to go back next year.